On behalf of MyBiz Expo, I'm very proud to announce the next speaker sponsored by Kiwi Bank, Mr. Bernard Hickey. Bernard Hickey's a leading financial journalist and editor with over 18 years' experience in the field, which includes roles with Reuters, the Financial Times Group, Fairfax Media in Wellington, Canberra, Sydney, London and Singapore. Bernard's also currently the editor of interest.co.nz, a news and information website aimed at 2 million New Zealand borrowers and savers, many of whom are probably SMEs, I'd imagine, Bernard, and as a commentator on the financial, economic and investment issues, regularly appearing in radio, television and in the Herald on Sundays. He's an outstanding speaker and we're very thankful to Kiwi Bank in their sponsoring of Bernard's speaking engagement today. So without further ado, I'll hand you over to Bernard. Thank you.
G'day, how's it going? Isn't it a fantastic day? I know you can't see the outside, but as you came in today, it's a glorious day in New Zealand. And if you take away one message from today's event, it's that New Zealand is actually a great place to do business. We're really popular at the moment. Everyone wants to live here, to come here and to bring their capital here. It's one of the reasons the New Zealand dollar is so strong. And I'm going to talk today about what life is like for businesses in this new normal after the global financial crisis. I'll try and explain why it is New Zealand is so popular, why we're doing better than the rest of the world, why, as another economist said to me the other day, we're the best looking horse in the glue factory. And what I'm going to try and do is explain the opportunities around for businesses in that new world, that new normal. And I'm going to talk in particular a lot about the causes of the global financial crisis. Why is this such a different time? Why won't the economy bounce back like it normally does? Why haven't we seen growth in the last couple of years like many people expected, including Treasury, the Reserve Bank, all sorts of economists? Why is it different this time? I'll try and explain that. I'll also talk about what that means for you as a business. How are you going to handle the way consumers feel differently about debt and about spending? How is your business going to deal with particularly the aging population? Where is the money gone? How do we appeal to those people with the money? Who are those people? I'll talk about that. I'll also talk about New Zealand's own earthquake. Firstly, a financial earthquake with the collapse of finance companies and the hit the New Zealand economy took in 2008 and continues to take in a way. But also, of course, the Christchurch earthquake. I know we're a long way from Christchurch. Is anyone here from Christchurch? Oh, we've got one person here from Christchurch, but this is a big factor in the growth of the New Zealand economy over the next couple of years. It's sucking in a lot of resources. It's going to keep the economy growing for the next couple of years, but also it's a factor, of course, in costs when you talk about insurance costs. And for many people owning commercial property through New Zealand, the earthquake is going to have some rippling effects on how keen banks are to lend to those commercial properties, particularly anything that's seen as earthquake damage prone. I'll talk too about housing markets. You can't really get past the New Zealand economy without thinking about what's going to happen to house prices, because so many small to medium businesses actually fund their businesses off their house and borrow the money against their house to fund their businesses. So it's important to know what's happening with house prices. I have the saying that in many ways the New Zealand economy is not a broad thing with lots of different parts. It's a housing market with bits tacked on, which unfortunately is still true after several years when we were supposed to have reformed away from that. I'll also talk about what's happening with interest rates. Why is it that this time around interest rates seem to be staying lower for longer? And how much longer will they stay low? Should you, for example, be fixing or floating? Who here has a fixed mortgage? Or a floating mortgage? And at some stage you will change from one to the other. Now, what are the factors going into that? How do you think about shifting from fixing to floating? I'll talk about that and the broad spread of factors driving the global economy factor into that decision about fixing versus floating. So, I'm going to try and introduce a couple of concepts today. Things that really matter for your customers and also for your own businesses and for those people with debt, and most people have in some form of debt or in fact savings, deleveraging is a really important concept to get your head around because it's pressing down on the global economy, how households are deleveraging, and the pressure on for governments to deleverage too. We'll talk about financial repression. Has anyone ever heard of this idea? This is the solution to the global financial crisis. And if you're a saver, and there may be a few people here who have money in savings accounts, you'd be surprised how much money is in savings accounts. This is a key thing to watch for. Financial repression. I'll explain that through the next 45 minutes or so. And if there's one surprise I want you to take away from today's session, one thing that you think, wow, I hadn't thought of things like that before, it's the power of demographics. So how the structure of your population changes, how people are aging, how their spending patterns and their saving patterns change as they move through the life cycle. Because we all think about spending and saving and investing differently as we get older. And the aging of the New Zealand population and the population of the developed world is affecting the way the economy works. And I'll try and get that across. And hopefully you can see within these explanations and the detail I talk about the opportunities for your business. Now everyone's got different types of businesses, you've got different types of customers, your own situation will be different, but within that I'll try and point to some of the opportunities for making money in this new normal. That's what we're going to talk about in the next 40 minutes or so. And please, this audience is small enough, so if you've got a question and you've got something to challenge me on, feel free to grab the mic off Brent and throw it at me. I love nothing better than a good debate. And I'm sure some of the ideas and things I talk about today, you'll go, hang on a minute, that's not right. What's he going on about? Well, feel free to jump up and say, what do you think? Right, let's talk now about how the world is going to get older, and particularly for those older groups, quite a bit wealthier. If you're thinking about opportunities, it's the opportunity of an aging population that for you as a small to medium business person, you should look out for. Those people are cashed up. I'm going to show you a chart later on which will really surprise you. It shows that the amount of money in New Zealand term deposit accounts in banks, it's pretty accessible, you know, you can pull it out within 6 to 12 months notice. In fact, a lot of it's even at cash interest rates. That number has risen. Let you guess, how much money do you think is in New Zealand bank accounts ready to be spent? $1 billion? 10 billion? 50 billion? Yes. 70 billion, good guess. It's actually 110 billion. $110 billion is sitting in term deposit accounts and banks ready to be spent when someone feels like it. That has grown from 45 billion in the last 6 years. So when you hear about, oh, New Zealand's so tough and so poor and we just have no money to spend, actually they're putting it in the bank. And that's money that if you're good enough, you can convince people to prize out and spend on your stuff. And it's interesting who's got that money too. They tend to be older and wealthier. And they're saving for their retirement, but they're also a little bit nervous about the future. And some of them will at some stage think about spending that. And that's an opportunity for you. We'll talk about capital flows. So many of your businesses will rely on sales to consumers and will rely on the strength of the economy. Many of you will be importers. And those capital flows that are going around the world at the moment, a good chunk of them are ending up in New Zealand. You'd be surprised how much is coming here. And in fact, very close to this venue. A little anecdote before I get going. I own a house actually about 400 metres as the crow flies from here. And around that area, Grammar Zone, for those people who are in Auckland, very important thing to put on the ad when you're selling a house, double Grammar Zones. There's an enormous amount of interest from Asian investors in those Grammar Zone areas. And a little anecdote, about 4 months ago, a guy came from China. He was an official in China, a very wealthy man, as officials in China sometimes can be. And he wanted to put some money into New Zealand because he thought it was a fantastic place. You could invest here really easily. And it was, in fact, better than gold bars to buy a house in Auckland, in Epsom. And he flew in one night, rang up the real estate agent and said, I want to have a look at that house. And it was a townhouse, actually not very far from here, about 300-400 metres as the crow flies. A townhouse, brand new, built on one of those subdivided sections. So, you know, the classic subdivide, put the house at the back. Had a CV of about $1.4 million, which is, of course, crazy in Auckland, but that's the case. He eventually went to auction. The next day, he flew in on the one day, saw the house at 10 o'clock at night, went to the auction the next morning, bid the price up to $2.3 million. So CV 1.45, expected to go for 1.89, went for $2.3 million. He then flew out that afternoon back to China. That house is still empty. It's just sitting there, no one's living in it. Brand new townhouse, 3 bedrooms, 2 bathrooms, fantastic for a family. It's just sitting there. Why did he put that money here? Because the New Zealand dollar is so strong, we don't have many controls on our capital flows, unlike the rest of the world, and money is being printed in the rest of the world, those currencies are being devalued, ours is rising. That's a little anecdote about how popular New Zealand is and the power of those capital flows to increase asset prices. If you happen to be in the double grammar zone in Auckland, it helps. But it's one of the reasons why the New Zealand dollar is strong. Capital is flowing. New Zealand is seen as a safe haven. So, you know, some of the things I'm going to talk about today are pretty sobering, and you wonder, well, there's no hope for us. Well, actually, one of the reasons there's plenty of hope for New Zealand is that we're so popular. They love us. They want to come and spend their money here, they want to invest their money here, and at the moment there's nothing to stop them from doing that. And that means we're going to have a strong currency, yes.
I thought the housing going up.
Go for it.
Hi, my name is Sam. My understanding was the housing going up because the value of the money is decreasing. So one of the things I actually read a lot of it is American teachings, what Americans are printing, it's the worst thing that you would do is put money into the bank as savings, because the money itself, it's not banked by gold, so it's deteriorating in value.
Yep.
What do you say about that?
So you're right. Those people who are worried about inflation in the rest of the world and about their currencies being devalued by all this money printing, and it's happening in China too, they're looking at the world and going, okay, let's invest in an asset that's safe against inflation. And property is one of those assets. But even better, why not invest in property in a currency where they're not printing money? And that is New Zealand. We're borrowing money from the rest of the world, but they see us as a safer haven than everywhere else, so they're putting their money here, and that's pushing up the currency. So that means people are winning both ways. They're winning from rising asset prices, particularly for house prices in Auckland, and it's an Auckland and Christchurch phenomenon mostly, but also they're winning from a rising currency. So if you've got renminbi, yuan, or US dollars or whatever, you put your money here, you win both ways. It's like a one-way bet, and that's one of the reasons why the New Zealand dollar is so strong at the moment. And that is actually great for importers. Who here imports? There must be a few people here who own businesses and are importing and selling to consumers. Great news for you, the New Zealand dollar's strength, particularly if you're importing in US dollars. And also in euro, not so much in Australian dollars, although that's also getting a bit stronger too. Now, I have this little saying, I love charts. I'm a bit sad like that. I'm one of these, economists who loves to look at charts, and I call it my chart porn. It's my way of relaxing. It's my way of trying to understand things. And this is one of my favourite pieces of chart porn because it helps explain what's actually happening in the global economy. This chart shows US debt. So how much debt is in the US economy? Important to watch the United States because it's the world's largest economy. And what happens there often sort of flows to the rest of us. We should care what happens there. And this chart goes back to 1920. Some of you at the back may not be able to see this, but this is 1920 here at this end of the chart. This is 2020 here at this end of the chart. And I love a good long-term chart. There's nothing better than long-term chart porn, I think. Bigger is better in terms of chart porn, longer is better. Now, the red line is private sector debt in the United States. How much debt do households and corporates have? And this shows that in the 1920s, you remember the Roaring Twenties, you know, the flappers' dresses and the Jazz Age, and everyone had a ball. It was a fantastic time, in part because there was so much money pumping around. And interest rates were low, people were spending money, and they were investing in stocks and all sorts of things. You can see here, debt rose to 240% of GDP. So just imagine your own incomes. You have debt worth 2.5 times your own income. That's quite a lot of debt. And you can see here, it rose very quickly. Till, of course, in 1929, we had the stock market crash and the beginning of the Great Depression. And during the Depression, people repay debt, or that debt is destroyed, mainly because banks fall over, or because people go bankrupt and assets are sold. And a period of very quick deleveraging is a bad thing, because it means that everyone's repaying debt, no one's spending money. And of course, you see enormous financial stress and banks go under. So we saw that through the Great Depression. Enormously quick and big deleveraging, from 240% of GDP down to 40% in the space of about 10 years, 10 to 15 years. Extraordinary pressure and pain in the global economy. And at that time, the blue line is government debt, right? So often you want those lines not to be going down at the same time, because that means no one is spending any money, not the government, not the private sector. And for a short period in those 1930s, that was happening. That's indicative of a depression. When debt goes down at the same time, deleveraging both the private sector and the government sector, you have what they call the paradox of thrift. Has anyone heard of this? This is where the paradox of thrift. So this is where it's a good idea to save money, right? People say to you, save money is good. Everyone should save money. But what happens when everyone saves money at the same time? No one spends any money. So if you've got a shop and you're saying save money, that means they're not spending in your shop, they're not spending in their shop. That person who owns that shop's not spending any money. Eventually everything grinds to a halt. That's what happens during a depression. And what you need when the private sector is deleveraging, when the private sector is repaying debt, is for the government to step up on the other side. So, and this is what we saw during the late 30s and early 40s. We saw almost accidentally government step up on the other side and spend money and invest money in new technologies. Now, unfortunately, we all know what was happening with all that government spending on new technologies and investment in infrastructure. It was actually military infrastructure and military technologies. Really interesting though, you saw an enormous amount of growth during the period after that war. And that growth was powered by the new technologies invented during the late 30s and through the 40s. So when you think about it, jet engine technology, right? You've got avionics, radar, computing, nuclear energy. All that was powered by government investment, government spending through the 30s and 40s, through this period. And you saw a sharp rise in government debt. But that helped soften the blow of the Depression and helped the global economy recover. And that's a theme I think we'll see in the next 10 to 20 years. Government spending, government investment taking over where the private sector is not spending. Just now, fast forward through the good times, the 1950s and 60s from the global economy point of view, and leverage, the amount of debt in the economy, US economy, rose reasonably slowly to a quite sustainable level. Remember, if you've got debt of 1 times your income, that's pretty good. That's how much you can handle that. And this was sort of normal. So through the 50s and 60s, you know, lots of good growth, lots of good employment, people were earning good wages. A lot of the GIs came back from the war, got trained up at government expense at universities and polytechs. They don't call them polytechs in the United States, they call them colleges, but anyway, that helped power growth. People went into factories, off the farms, became rich, spent their money. You had the growth of a very strong middle class in America and in many other parts of the developed world. It was a good time. And so you saw leverage increase a little bit. Government leverage went down as you know, the economy grew, the government didn't need to spend money on unemployment payments and all sorts of things, and things were pretty good. Then something happened. The world changed. And it started really changing around the 1990s, and then again through the 2000s. And there's a couple of reasons why households, consumers, took on so much more debt. A couple of reasons. The first reason is that they were young and sexy, young and having kids, young and buying houses, young and borrowing money to buy houses, young and borrowing money to put money into stocks, young investing in stocks, investing in companies that invested and spent and got the economy growing. So through the 80s and 90s, the baby boomers, the ones who were born around here, through the 70s and 80s, was the time when they started coming into the workforce. We also had a lot of women come into the workforce as well. I like to say that the invention of the pill was not a social event, it was an economic event, because it reduced the birth rate and it also allowed a lot of women to go back into the workforce. And that increased also the amount of output in the economy and really got things going. So these were golden times through the 60s, 70s and 80s. And then those baby boomers really started to hit their strides and start borrowing. But they were helped. They were helped by a massively reformed and unleashed banking sector in the United States. Now, who here has heard of ninja loans? Ninja? No income, no jobs, no assets. You could get a loan if you had no incomes, no jobs, no assets, and a pulse. It was important that you had a pulse, because then you got the loan. Fantastic. And these banks were unleashed. During this time, the 1930s, banks were regulated really hard in America. They couldn't go around spraying money around at everyone. You had to have more than a pulse to get a loan then. And the banks had to be really sure before they lent to you. But during this period, there was a piece of legislation called the Glass-Steagall Act. Now, you don't need to know this, I'm not asking you to take notes, but the Glass-Steagall Act was reformed, and this meant the banks could really go ballistic, and they did. They lent extraordinary amounts through the 90s and the 2000s, to the point where, in 2007, debt to GDP for the private sector, remember this was the beginning of the bad times, this was really bad, it got to 300% of GDP in the United States. There's an enormous amount of debt sitting on top of the economy. And what did we see? We saw the global financial crisis of 2008, and the world of the financial system of the world almost blew up. In fact, and this is a really sad thing that I get grumpy about, the one company that almost blew up the world is now emblazoned across the front of the all-black shirt. AIG. What the hell is Richie McCaw going to be going around advertising AIG? This company almost blew up the world. In fact, the government of the United States let Lehman Brothers collapse because they thought it was a good thing for bad banks to collapse. And then the next week, AIG almost collapsed. And then they realised, if that one collapses, the whole thing goes bang. So they rescued AIG, bailed it out enormously, found all sorts of dodgy things in there. Has AIG got a stall here? I'm sure they don't. And so we saw huge amounts of deleveraging quite quick, and that was obviously the global financial crisis, which is still going on, and you wonder why is it still going on? Why 5 years into this thing are we still grinding our way through? Well, the reason is this level of leverage has to come down to here. So remember, each one of those lines, the width of that is 10 years. So it's quite a long period of time. Short on the graph, but a long period of time. Remember, long-term chart porn is the best? 10 years. To get to something normal, which is around about here, around about the 100% mark, it's going to take a couple of decades, right? A couple of decades of deleveraging. And the government's going to have to step up on the other side. Now, that's the debate we're having right now. In fact, we're having the debate in New Zealand too. This is very similar to our government chart. In fact, we're lucky our debt's quite low, but it's growing. But in a good way, our government kept spending money through the last 4 or 5 years, ran big government deficits. If it hadn't, we would have had a depression as well. And a lot of other governments have done the same. Now the debate is, should those governments pull into their shells and stop spending? I would argue no, because if they do, at the same time as everyone's deleveraging, we get a depression. That's the big debate Europe is having and the United States is having. Watch the election results in the United States, because the Republicans want to carry on with the austerity, which I think is actually really dangerous, and there's lots of other people saying the same thing too. Okay, so there's the world of debt. That's the thing hanging on top of the global economy right now. This is why things aren't really cracking on, why we're not bouncing out. Why aren't we bouncing out? Well, because there's so much debt sitting on top. That's the big picture. That's the big piece of chart porn to watch. Aha, now, that was the United States. What about the rest of the world? Have a look at this one. The UK, Japan, Sweden. Here's the United States here. Its debt isn't actually that high compared to the rest of the world. Who here has money in a British bank account? Don't tell anyone, but take it out now. That is an extraordinarily high amount of debt in an economy. That green stuff, everyone here's been to London, right? Or they may have seen London. There's the City of London, and there's the Canary Wharf, the areas with all those bankers, the Shard, the Gherkin, whatever they call it, right? That's where all those bankers, those international bankers, have that debt. That's the green stuff. That's the bad stuff that when markets shut down, taxpayers have to bail out. So that debt is sitting on top of the British economy. I wouldn't put any money into Britain right now, or leave it there. That's Japan. They have their own particular problems, ageing, and we'll talk about that in a second. Here we are here, right? You remember I talked at the start, it's such a beautiful day, and we all want to put our money into New Zealand, and even the Chinese officials with all that money, how did they get all that money? Working overtime? I don't think so. They all want to put their money in New Zealand. Why is that? Because we're the best looking horse in the glue factory, like I was saying. We're looking pretty good. Household debt's a bit of a problem, and that's one of the reasons for those who are selling to consumers are struggling a little bit, because households they want to repay their debt. But the rest is pretty good actually, and there's a very low government debt. So there is a world of debt. It is pressing down on the global economy. It means that this rebound is not as fast as we all thought it would be, but we're in a pretty good position. Okay, how come we haven't had a depression? Why aren't we all, talking like it was the 1933 or 1934? Because we're not. We haven't had a depression. The world didn't end. Came pretty close. Thanks to those frickers at AIG. What happened? Well, the world's central banks and the world's governments decided to essentially bail out the system. They did it in various ways. They used taxpayer money to bail out big banks, Royal Bank of Scotland, Citigroup, Barclays, Halifax Bank of Scotland. All these banks got bailed out, either with direct injections of cash from the government, or they were given discounted money from central banks. And I still don't understand why there haven't been riots in the streets over that, but anyway, it happened. And then central banks, particularly in America, but increasingly in Europe, Japan, England, have started printing money to try and keep the system afloat, to push money into that system, to try and get people to borrow, just to make sure they keep, things cycling along. And they printed money and essentially bought government bonds to lower long-term interest rates, to encourage people to borrow. It hasn't really worked brilliantly, but it's kept things afloat. And these lines here, the light blue line is the US Federal Reserve's assets, i.e. how much money they've printed. So they did quite a bit of money printing through 2010, that's a QE2 they call it, and they've just embarked, some of you may have heard of QE3. I actually call it QE infinity, because what they've said is they're going to print $40 billion a month and do it month upon month upon month, endless, until they get the unemployment rate down to something which they haven't said it is. They just keep printing and printing and printing and printing, QE infinity. And then the European Central Bank, because of the European financial crisis, started printing money in a rapid way through late 2011, and they have just announced something they call the Big Bazooka, which is to buy in an unlimited fashion Spanish and Italian bonds when the Spanish ask for a bailout. This is what's happening in the rest of the world. I'm not sure a lot of New Zealanders know this. This is why our currency is so strong. The Europeans, the Americans, the Japanese, the English, the Chinese, because they have a currency connected to America, are printing money like there's no tomorrow. They are hoping there's going to be a tomorrow, but they are printing like there's no tomorrow. That's one of the reasons our New Zealand dollar is so strong. They have effectively decided on a strategy of print, extend the period of the loan, and pretend that the growth will come. Well, they're sort of forecasting it and they're hoping the growth will come, and that will help essentially bail out the world. And it might do. You know, they might manage to keep everything together, keep those fires under control long enough to get through it. And that's the strategy that's being pursued. Along with that strategy is something called financial repression. This is where the central bank prints money, buys government bonds, and sets short-term interest rates very low, and then just quietly, without really telling anyone, pushes up the inflation rate just above those interest rates. Why would it do that? Why would it? Yes? Yes. So what you're saying is?
To dissipate the existing currency that's in position and effectively depreciate that so that the value of the currency is a lot less to...
Yeah, and that's one of the reasons they're doing it, is to try and solve their problem by boosting their export sector, getting someone else to buy their stuff. Now, again, it's a bit like the paradox of thrift. That works when you're doing it and everyone else isn't, right? It works when you're printing and everyone else isn't. Their currency rises, yours falls, you export your stuff to them, and then you build yourself up like that. Trouble is, when everyone does it at the same time, it's bad. And that's effectively what's happening in the rest of the world right now. That's why our currency, the currency in Brazil, South Africa, are rising, and why there's so much concern about these capital flows cascading around the world. Printed money squirting out the sides and zipping into New Zealand. That's where that money's going. It's going into that 3-bedroom, 2-bathroom townhouse that's empty in Epsom. Great for the New Zealand dollar if you're a consumer, if you're an importer. Not so much fun if you're an exporter. Okay, now, I've hopefully got across the idea of financial repression. That's where interest rates are pressed low, lower than savings rates, so that the debt that's there effectively gets eaten away by the effects of inflation. So who here has money in a term deposit account? There must be some people with cash savings, it's good. You worry that when you put your money in the bank, that the returns you get from that bank, the interest rate, after you've paid the withholding tax, and it might be at the moment around 2.5%, 3% if you're lucky, you hope that that's as high or higher than the inflation rate. When inflation is running at 4 or 5% and you're only getting 3% back, you know that your savings are being eroded. And that is the dirty little secret of central banking at the moment. Those central banks are repressing interest rates, trying to build up inflation to make the debt go away in a very quiet, sneaky way. That's financial repression. And they're hoping that those people with savings let them get away with it. And they may well do. Perhaps that's better, that sneaky, quiet, drip, drip, drip is a much better way to deal with debt than having a mass restructuring and depression. Probably is. But, you know, there must be a generation of people going, I'm a little bit worried about inflation. My personal view, that there isn't so much of a worry about inflation, because when you have this much deleveraging going on, it actually pushes down on prices, and you have a deflation as your problem. Okay, demographic sweet spots. Remember I said the one surprise, the thing that you might take away from this and go, we have an aging population, and that's changing the way people save and spend on your products and services, right? This chart shows you when economies had the sweet spot, when they had those young, sexy people getting pregnant, buying houses, borrowing money, spending money, producing lots. When everyone was in their most productive, sexy, 25 to 45. I'm still 45, so I'm still sexy. That time in the developed market, and we're in this development market chunk here, was 1950 to about 2005. That's when the economy was really strong and growing and people were spending money. Once you get past the age of 50, 55, you're really interested in saving money, putting money into a term deposit. Who here, and I won't ask the women to do this, who here is over 50 or 55? 50. So you're probably thinking about saving, you're thinking about retirement, you're thinking about where do I put my money? I probably paid off the mortgage, how do I get by? I'm not going to be spending it, I'm going to be a lot more cautious. So that ended about 2005 for the developed world. That's going to keep spending under control. It's going to mean there's quite a bit of savings around for that audience, for that group. Now Russia, their sweet spot's a bit later. China, and particularly Asia, they're still in the middle of their sweet spot, and that's one of the reasons why New Zealand's doing so well. We're selling into their sweet spot. All those young and sexy Chinese people are buying our stuff, which is great. That'll end though. At some point China's population starts to fall as well, probably about 2025, 2030. That's when we better keep an eye out for Africa. That's when we should be selling our stuff to Africa. The one message to take away from this piece of chart-porn is aging populations matter. And in the developed world, there is an aging population problem. And that's helping to depress economic growth and increase, ironically, savings. But also as an opportunity for you as people in business. Who has the money? What are they spending it on? The people who have the money tend to have it in a bank account. They tend to be older. And they might be interested in spending it on themselves. You know, they might be interested in buying a new kitchen, they might be interested in going on a holiday, they might be interested in buying ramps, I don't know. But that's an opportunity, that's where the money is, in those older groups. Now, let's go to the place with the biggest aging problem, Japan. Here's a little factoid that'll probably make you squirm in your seat a bit. In Japan, they sell more adult nappies than they do child's nappies. Think about that. Maybe don't think about that. More adult nappies than child nappies because it's got such an old population. And unfortunately in Japan they don't allow in migrants, right? We allow migrants in, they tend to be younger. Japan, they're not keen on migrants, so they've got this aging population. In fact, it's been falling for the last 5 or 10 years. What does that mean? That means lots of savings stuck into bonds and other things. And their economies grow slowly because they're not the sexy ones anymore, they're the slow, non-spending ones. And so this is short-term Japanese interest rates. Since their property bubble burst in late 1980s, their short-term interest rate's been dropped to 0. So that's 0, right? It's been 0 since the mid-1990s. Count them. 10, 20 years of 0% interest rates. That's what an aging population and the bursting of a property bubble does to your interest rates. Lower for longer. I'm going to say this again and again. Lower for longer. Now, we're not completely like Japan. Our population is a bit younger and a bit more dynamic. We've got people coming in, we've got people going out. But some of those same pressures are there for lower for longer interest rates. So what does that mean? Central banks are trying to muddle through, and they might get there. They might not. But they're doing their darndest. That, as I talked about, means printing. Trying to inflate. I'm not sure they actually get there, actually. I mean, your worries about inflation? I don't know, particularly in the developed world. There's a lot of deleveraging going on. That first chart, that pushes down prices. That might mean some debt restructuring in the rest of the world. We've had some of it, particularly in the United States. We haven't had it yet in Europe, and that's one of the reasons there's so much stress in Europe at the moment. It's going to create some generational pressures, right? Just imagine if you're older and you've got money in a term deposit account, part of that $110 billion, what would you vote for? Would you vote for policies that create inflation? No. Would you vote for policies that create deflation? No. Well, actually, yes. Because deflation, if you've got savings, is fantastic. It means you wait around, you pull the money out later, and you can spend it on more stuff. So there's going to be some stresses there. Younger people are going to want inflation. Older people are going to not want inflation. There's going to be some stresses there. And particularly younger people are going to get grumpy about paying out benefits to older people, rightly or wrongly. There's going to be people who hunt for safe havens. Remember our very wealthy official mate? He's looking for a safe haven, and right now it's Epsom, double grammar zone. That's creating opportunities. So you'll know your business. I don't know your business, but you'll know your business and you'll know about which parts of your customer base are more likely to have money in the next 10 to 20 years? Tend to be older. They'll have money in a bank account. They might want to spend it. Consumers, those people in debt, are going to want to try and repay debt, so they're maybe not so keen to spend it. Debt's going to be cheap though. So there might be some people who say, lower interest rates for longer. Well, hey, leverage up, go for it. Maybe. If inflation takes off, fantastic. Particularly if interest rates stay low and inflation takes off, woohoo. So debt's going to be cheap. And there'll be a lot of banks offering to lend you money because debt's cheap. There are some supply constraints in New Zealand for housing in particular, and this is one of the real problems in Auckland. One of the reasons why house prices have risen 10 to 20% in parts of Auckland in the last year. Obviously in Christchurch too, for the obvious reason that so much of the housing stock was taken out. And we're so crap, frankly, at building new houses in New Zealand. You know, we're only building about 2,000 to 3,000 houses in Auckland every year. And we actually need 10 to 12,000 a year. We just need to somehow build a shed load of houses quickly. We're not doing that at the moment. What does that mean? Not enough supply, plenty of demand from migrants, both internal and external. House prices in Auckland remain elevated. We're going to see these capital inflows. Remember, safe haven hunting. We're not printing, they are printing. Look around for safe havens. That's why they're coming to New Zealand. Lower rates, potential for the official cash rate here to actually be lowered. That has some interesting implications. Too big to fail. You might have heard this phrase around about. What does that mean? It means some banks, actually the big four in New Zealand, are too big to fail. They won't be allowed to fail by a government. And some would say the property market in New Zealand is too big to fail too. Either the banks won't allow it and a politician won't allow it. So that was one of the reasons why property has done so well in the last couple of years. Now, just to give you a sense of this lower for longer, you want to take away one message: interest rates stay low. This is a chart from September last year from the Reserve Bank of New Zealand. They forecast interest rates out a couple of years. So this, remember, this is a year ago, just before we won the World Cup. We were all a bit nervous, you know. Are we going to win it? Is Richie going to... As we turned out, Richie had a blinking broken foot. Amazing. And poor old Dan Carter was about to do his groin. September last year. Back then, the Reserve Bank was saying, we're going to put up the official cash rate to just over 4% from 2.5%. So that's, you know, an extra 1.5% on your floating mortgage rate. That's what they were saying back then. And they actually lowered their forecast track at that stage from that almost up to 5% back in June 2011 to 4.5%. Now, fast forward a year. We're the World Cup champions. Dan's playing again. Great. That's the track the Reserve Bank has now. So the Reserve Bank has progressively lowered and lowered its forecast track. To the point now where they see the official cash rate, those sorts of interest rates, rising just 0.5% in the next 3 years. That's why so many banks have very low 1 and 2 year fixed mortgage rates. And that's why financial markets are forecasting interest rates stay low for the next 2 to 3 years. And it's because of this deleveraging pressure all around the world and very slow economic growth. Lower for longer, like a lot longer. To the point now where one bank, and that's Kiwi Bank, is offering 4.99% for 2 years. And when you push your banks, they'll try and match it, the other banks. Now, who here is a borrower? Who here has to go to their bank every now and again? That includes me. Be sure to ask for a really good deal. Why is that? Because our banks are very profitable and very strong, and they frankly can afford it. This is net interest margins for the banks in New Zealand. Competition through the late 2000s, you know, the various mortgage wars cut their profit margins, although they were still making lots of profit because they were lending lots more, to around that 2% level. Since the global financial crisis has happened, the banks have started increasing their prices, essentially, their net interest margin. And it's risen about 30 basis points. Doesn't sound like a lot, represents around about $1 billion in profit. What that means is that our banks are cashed up, they're strong, and they've got a bit of fat to play with, a bit like me actually, a bit of fat to play with to give you a better deal. And this chart from the Reserve Bank shows how credit standards are easing. Now this one here is household credit standards. This is your bank manager deciding to give you a better deal. So saying to you, I'll lend you 95% instead of 90%. Or I'll give you the break fees on the mortgage. Or I will give you the legal fees. You know the stuff we used to do in 2004, 5, 6, 7? They're doing it again. This red dot, this one here, shows you expectations of credit standards from credit lending officers in the banks, as surveyed by the Reserve Bank. And the last one shows a significant loosening of standards. That says, go to your bank and push them hard for a good deal and for, you know, as much as you can possibly get, because they're in a mood to give you the deal. Now, this chart sort of explains a lot about New Zealand's housing market and explains a lot about people's savings and spending habits. To give you an idea, through the housing boom, must have been people here who owned property during 2002 to 2005. It was a fantastic time. The economy was growing 4 or 5%. You may have been running your businesses and things were great. That was because for every house that was sold, we borrowed just as much. So this red line is the value of house sales. It was about $2 billion a month we spent on houses. And the blue line is the value of credit growth, right? So that says for every $2 billion worth of houses we bought, we borrowed $2 billion from the bank. So that meant that we weren't actually using our savings to buy houses, we were just borrowing a lot. Now, they moved very closely together up until the global financial crisis, and then they diverged. And what you saw was that the value of house sales stayed up, not as high as it was, but about half the level. But the amount of credit growth went down. What that says, this gap here between the red and the blue lines is effectively deleveraging and savings. People are selling their house for $800,000 and buying another house for $400,000 and repaying the debt. That's what that gap means. Or it means people only borrowing 80% to buy a house instead of borrowing 95% to buy a house. That's that gap. And that's why term deposits have gone from 45 billion to 110 billion in the last 6 to 7 years. People, and particularly households and consumers, have been saving like mad. And that's why if you've been in business and you're trying to work out why aren't people spending money like they used to, that's the reason. They're repaying debt and they're deleveraging as much as they can. It's not just happening here, it's happening all around the world. That's the power of deleveraging to change your business and the appetites for spending of your consumers. But it means they do have money to spend, those who have repaid their mortgages, and a lot of people are repaying their mortgages faster than they need to. So that is a disconnection in the economy between credit growth and spending. And this again, this chart I showed you, talked about the one where term deposits rise from 45 billion to 110 billion. That means there is money out there. It's sitting in bank accounts, ready to be spent if you can price it out of people. Good luck with that. Just a quick one on crowded houses. Everyone here owns a house or lives in a house of some sort, and will have noticed some big changes in the way people live in houses over the last 20, 30 years. Often there's a lot of single person households, so someone might have retired and they're living by themselves, or there might have been a marriage breakup and they're living by themselves. And so the number of people per house has been dropping significantly since the 1990s. Also, we've been buying a lot of second houses. So remember those people who bought houses at the beach, but they don't live in them for most of the year, right? So that's an empty house. So the number of people per houses has gone from 2.7 down to 2.5 in the last 10 years or so. And what that represents is lots of demand for extra houses because there's fewer people per house. But interestingly, since 2008, that has rebounded. So people are moving back in with their parents. You know, people are moving in with flatmates. People are sleeping on couches, sometimes sleeping in garages. You know, there's a bit of that going on, particularly in Auckland. That's important to think about. Now, the question is how much lower can it go, or do we go back up here? Interesting question about how people live together and social structures. And just a final one, there must be quite a few Auckland residents here. Most of you are in Auckland, right? Just to give you a sense of how different Auckland is to the rest of the world, right? In New Zealand at least, our world, right? This is the change in house price between 2006 and 2011, which is the period of the global financial crisis. You know, we're talking 6% up. The number of people per dwelling right? So the number of people who are moving in with parents, living in garages, sleeping on couches, has risen sharply as well. So when you have a housing supply shortage and plenty of demand, this is what happens. They both go up. Not so much in Wellington. More people living with parents and things, but house prices are flat. The rest of New Zealand, anyone here from provincial New Zealand? You know, New Plymouth, Taranaki, Palmerston North, they have got a bit of a problem of losing population and people moving out of homes. And of course that's reducing the house prices. So the point of this slide is to say Auckland and Christchurch are different. The rest of the country may not have the same strong house prices that you've got here. And unfortunately, because we're not building enough houses, this is constraining supply, particularly in Auckland. This says, this was the boom time. Anyone here supplying the housing industry or construction sector? Must be a few people who are doing stuff like that. This will explain why things have been tough the last 4 or 5 years. We're just not building enough houses. This needs to get up here. This is why I get grumpy with governments, both central and local, and with what we're doing. We're not building enough houses. We really need to be building a shed load of houses. I've actually proposed, it doesn't make me popular, particularly with gold buyers, that we print money to build thousands of houses in Auckland. I'll let you think on that one. But if you're in the consumer sector and you're selling to consumers, consumers are starting to think about spending. This is spending growth for core retail sales in New Zealand over the last couple of years, and there has been a rebound. We are now growing reasonably quickly. And for those who are successful at selling to consumers, you will notice they are a little bit, the purse strings are starting to open up a bit, which is great. And if you're in the residential building or construction sector, Treasury is saying that we're going to see a bit of a boom in house building. Unfortunately, most of it's in Christchurch. In theory, some of it's going to be in Auckland. But there is going to be a bit of a rebound, and they are saying to growth levels above where it was in 2002-03. Now, I'm a little bit more cautious about that. I think, particularly in Auckland, affordability is a problem for most regular home buyers, not our very wealthy Chinese official, but people on, regular incomes of 50, 60K or so. So, just to summarise, before we have some time for questions, lower interest rates for longer, heavy deleveraging, pushing down on the global economy, central banks and governments printing money to cut interest rates below the inflation rate. Demographics matter a lot. Ageing populations change the way that people spend, the way they save, might even change politics. People who are older tend to be richer and they're saving a lot. They've got 110 billion sitting in bank accounts ready to spend. If you've got a product or service that appeals to those older people, good for you, because you should be able to pry it out. That's your task. People are less likely to build a new house now because there's a lot of pressure on consent costs and on construction costs. They're more likely to renovate or, unfortunately in Christchurch, to rebuild. And in Auckland, with the leaky building crisis, to rebuild. Imports are going to be cheaper. When people are buying our safe haven, they're pushing up the value of New Zealand dollar, which means imports are cheaper. Great time to be a consumer. I've even bought a flat screen TV in the last couple of years because they're so cheap. There's some other stuff going on there with lower electronics costs as well. Thank you very much. I hope I've kept you awake after lunch. I think I have. And I really welcome your questions. Yes? Sorry, just got the microphone behind you there. Yep.
I just read that Greece is getting worse and worse. What would you do?
Wow, dictator of Europe. Wow, that'll be fun. Well, at the moment, the strategy that the Europeans are applying, which is austerity, which is a German-led strategy to try and essentially crunch these economies into a German-style way of doing things. And that means cutting their spending on pensions, on government salaries, slashing workforces in the government sector, increasing tax rates to try and get their budgets back into balance is a disaster. Because we talk about the paradox of thrift. When Greece's government is spending less, and of course their consumers, who amazingly when they get paid less by the government spend less, Who would have thought that? They spend less, the government spends less. Their next door neighbours in Italy spend less. Their next door neighbours in Spain spend less. Ireland spend less. Suddenly everyone looks at each other and goes, who's spending more? No one. Maybe the Germans. No, the Germans are using a very low currency to export to everyone. And so you've got this basic problem. They think they can solve the problem by spending less, but everyone's spending less at the same time, and they're having a depression. I mean, Greece's economy is 30% lower, 30% smaller than it was 4 years ago. That is a depression by anyone's measure. Italy and Spain, particularly Spain, youth unemployment, guess what? 55% youth unemployment in Spain. Again, the same German strategy of austerity. It's not going to work. So what would I do if I was the dictator? I'd be a very friendly dictator. I wouldn't have one of those short moustaches. I'd be really nice. I'd say, spend money. I would say, particularly the Germans, you should be spending money on stuff from Italy and Greece. You should be going on holiday like 9 months of the year and spending all your money. That's one of the things. Actually, I think there's some fundamental problems with the structure of their currency. So they have come up with a single currency, but they don't have single budgets or single banking unions. My personal view is that to solve the European crisis in the fastest, least painful way, they need to break up the Eurozone. So Germany and France potentially form some sort of super euro. The rest of them break off and form the lira and the drachma and the peseta and whatever, the Irish punt. Now, when that happens, that's a really painful thing, because what it means is that the banks in Central Europe, well, Northern Europe, the Germans and the French and the Brits will have to take ginormous losses on all the money they lent to these other countries. Essentially, that wipes out the European banking system. That's fine, as long as the people who pay are the bondholders, pension funds, and other banks and other rich individuals who lent to those banks. The danger is that the banking system in Europe is wiped out and taxpayers bail them out. Taxpayers will own those banks eventually anyway, but the first people to take the losses should be the bondholders and the shareholders first. That's why I think you're going to see, in the long run, renationalisation of a lot of the European banking system. That's why I personally wouldn't have a single pound or euro in a British bank, and a lot of the European banks, particularly the Germans and the Spanish ones, and the French ones, I'd avoid like the plague. Yes?
If you were the housing czar of Auckland and could wave a magic wand, I think we're facing the perfect storm here in Auckland, because we've got bureaucracy stopping the rezoning of land, so land inside the zone's 8 to 10 times more valuable than just outside the zone. You've got your Chinese official coming in here and artificially inflating the prices. You've got income for Aucklanders as a percentage of house prices completely unsustainable. You've got bureaucrats controlling the city. The politicians are just jockeys on the horse for a moment in time. And basically Auckland is screwed. So as the Tsar, how will you fix this?
Well, I wouldn't grow a moustache, but you make some really good points. Firstly, on consenting and this problem of the metropolitan urban limit, where prices are much more valuable inside than out. Yes, we probably need a bit of sprawl. You know, there is this complete paranoia about sprawl. If you're going to do that, you need to make sure you put the infrastructure in, the motorways and the railway lines and all that sort of stuff. We also need a lot more what I call brownfields development, a lot more high-density development in Auckland. But at the moment, there is zero focus on affordable housing in local government. So I've never heard Len Brown talk about it in public. Now, I've spoken to him in private, and he says stuff in private. But put the pressure on him and say, right, consent spaces and help build 10,000 houses. Nothing. Same with the central government. Our government has decided that the market can deal with the problem. It's not. There are no finance companies to do the development for this stuff. We're just not building the houses. It's a disaster. So if I was the Tsar, wow, that'd be fun. If I was the Tsar, I would print money, force through consenting from local and central government, employ all these unemployed people, train them up to build 50,000, 100,000 houses in Auckland. Now, good ones that last, that aren't leaky, a good chunk of them in the central part of town. It may mean more townhousey, apartmenty style houses, but ones that people want to live in that actually are a decent cost. So we're talking 200,000, 300,000, 400,000, not 600,000, 700,000, 800,000. That's what I'd do. Boy, that'd be fun.
I think we're out of time, but please put your hands together for Bernard Hickey.